Omicron. The reporting out of the UK right now, not expecting to get new measures, expecting an update on the booster program. So one for the diary a little bit later. David, I want to come back to you on multiples. We talked a lot about earnings. It's been the big surprise of this year. You're talking about earnings being the big surprise for next year too, potentially. Let's just sit on multiples for a moment. There's been some confusion around why multiples are so elevated. I want to understand what it is from your perspective. Is it that early recovery where earnings start to deliver upside surprise, beat and raise? That's where Deutsche Bank sit on the idea. Or is it the fact that rates are low? And if it's rates, what does that mean for the Fed and what that means for multiples going forward? Can you give me your view on that right now, David?
So we think about valuation on an absolute metric. If you look at enterprise value to sales, enterprise value to EBITDA, price earnings multiple, any of those metrics, the equity valuations are extremely high. I would say the rationale for the market being reasonably attractive does depend on the extremely low interest rate environment that we have, whether that's corporate bond yields, TIPS, inflation, protected securities, or even nominal treasury yields. In all those interest rate related metrics, equities look reasonably attractive. So Jonathan, an important construct to think about is that in history, it shows 6 months before a Fed hike, 6 months after a Fed hike. That 1 year period, basically you have multiples flat. In every one of the tightening regimes that you've seen over time, that's been the experience. And so that happens to match up pretty closely with calendar year 22, coincidentally. You're starting now, it's about 6 months before the expected first hike, and 6 months after would, of course, put you at the end of 2022. That's not the forecast for a stable multiple. That's not upon which we make the forecast, but as a result, that's consistent with history. The way we think about it is rates are going higher, risk premium going a bit lower. Why is it a bit lower? Consumer confidence remains high, unemployment falling, and wages are increasing, number one. And number two, the policy uncertainty I referenced earlier about tax hikes, the election for next November. So once that's beyond us, you'll be basically back to a roughly stable valuation, around 20 to 21 times, which is the valuation now, historically high, but still reasonably attractive in a low interest rate environment, even with rates rising.
David, just brilliant. I hate to reduce the whole body of work to just an index level call, but fantastic on the index level through much of the last 12 months to you and the team. Good to catch up, as always. Enjoy the holidays, David. Thank you, sir.